Hi, Nigel here from Arch Capital, here for the end of July already. We're into the new financial year and markets are still being a little bit volatile. So I just wanted to run through a bit of a presentation we've put together to try to put into perspective what's going on in the world and how to put a bit of a long-term perspective into some of these factors. A lot of people are worried about, of course, interest rates, inflation. Numbers again this week are quite high. So what do we do about that? What can we do about it? What can we control? So the first slide I just want to go through here is talking about the noise and the markets, and obviously in the financial review or websites you see, ABC News, wherever it might be, some of those headlines are a little bit daunting. We know that, so it gets our emotions going. We sort of want to know what to do about it, and does it affect me? Does it affect you? So when I look at it, we obviously worry about our clients and go, what are they thinking? How are we trying to communicate? How to put this in perspective? When we look at long-term returns, all these sort of things have happened in the past, and they're a bit different every time, but at the same time, markets deal with it in a fairly consistent manner when we look at it. If we take the long term, and we've got data now going back, a long time, decades and decades, and we can see that the long-term returns are there. We know that capital markets work, but of course, right in the heat of the moment, we're not sure. We're not sure if things are different. We're not sure if the media is right this time. Have things changed? The media will say we've never seen things like this before, but maybe we have. But certainly when we look at the data, long-term returns over many periods still remain strong, whether there's been a COVID, a GFC, a dot-com crisis, whatever the case may be. So again, going through a bit of a market volatility now, and what we want to do is again look at some of the data of what's going on right now and what that might look like going forward. So obviously we know the markets come down. If we look at the S&P, which is the US market, if we look at the Australian market, everything's been a bit negative. Seen a bit of a pickup in this month. So we know those facts. We know that obviously there's been this downturn after some pretty good years, but there's been this downturn in markets. And what's been really driving that is a change in the economic climate from low interest rates to high interest rates, high inflation. There's also obviously some geopolitical issues in the Ukraine and elsewhere in the world. So some of these things are obviously affecting supply chains, affecting prices, and putting some constraints on the economy. Now, for many of you who've been in our meetings, we often run through this software which runs through some capital projections, and we try to say, well, if things change, if there's a certain type of return or returns change, and what does that look like? So if you're interested in that, an update, we can run you through it. Of course, it's assumption based, but we can change all sorts of factors in there to give a bit of comfort that, if the markets are a little bit down this year, what impact does it make over a long term? Does that mean your capital is going to last to 85, 95, 105? What impact does that make? So please reach out and we can run you through that one by one. What we do know in this chart here is that markets always bounce back, no matter what. So we've got here the 1 year, 3 year and 5 year. This over here says the return after a 10% market decline. After 5 years, if the market's fallen 10%, the market was back up 68%. If the market fell 20%, after 5 years the market was back up 71%, but after 3 years 41%, and after 1 year up 22% on average. And this data is from 1926 to 2021, so a long time. And if the market falls 30%, then the average return after that has been 50% over the 5 years, 16% 3 years, and 23% 1 year. So these are facts we know. These are facts that we know that what happens when markets fall, they come back in every situation since 1926. So that's good to know. And we know all these things that have happened a long time. Since 1900, the market's risen, but there's been these ups and downs, and there's times where people get worried about, we don't want to invest it here or here or here, we don't know exactly what's going to happen tomorrow. We don't, but we can use some of this data to give us faith that we should keep investing through periods of a rebalancing or slowly investing new money into the market, because there's a pretty good chance that it will recover and get better in the future. And it's these emotions we're talking about. When we're optimistic, there's elation in markets, nervous, fear. We don't want to be doing the wrong thing at the wrong time, but we're wide. There's a famous academic called Daniel Kahneman who's won a Nobel Prize for this sort of research. It shows that humans, we're wired to do the wrong thing. So we should be, when markets are low, we should be buying. But people get scared and nervous. So again, if you've got the right strategy, then that can be the right thing to do. If you've got the right long-term strategy, if you've got enough cash and fixed interest, if you're retired, but you've got a little bit more than you need, then now's not a bad time to be rebalancing. keep that long-term perspective in mind. But obviously, always keep enough money in cash and fixed interest for your expenditure and that protection as well. We've touched on this about the headlines. This is going to continue. The media is great. We've got lots of information, but they're talking about today or yesterday or the past. They don't really know what's going to happen in the future. But of course, we all know that. They sell papers by headlines. They don't sell papers by saying everything's okay. So just be aware of that. It's content, some great content out there, but no one knows exactly what's going to happen in the future, unfortunately. We wish we did. So what we can control is we want to create an investment plan. Everyone should have an investment plan that suits their risk tolerance. So the asset allocation or portfolio you can hold on to is the one that's right for you, and everyone's different. You want to structure along that portfolio along those dimensions of return. So keep it diversified. Make sure you've got enough cash and fixed interest for the protection side of it and liquidity, but enough in the growth assets. We're going through an inflationary period, so we want to have growth assets because we don't want to. We want to make sure that we've got exposure to those assets that are going to grow, particularly in a high inflation environment or potentially a high inflation environment. We want to diversify globally. I want to manage those expenses, turnover and taxes, and we want to stay really disciplined. So one of these things that we talk about a lot is just keep sticking to that plan, staying disciplined through these cycles. So that's from today's point of view. That's a bit of a longer one than normal. I hope it's been helpful. Of course, we're here to help. Looking forward to speaking to you soon. Thanks for listening.